Good evening. Welcome to today's webinar, Career Insights, Passive Investing in India, hosted by CFA Society India and CFA Institute. I would like to take a moment to welcome our audience from around the world who are joining us remotely. I am Rajendra Kalur, CFA, Director Research and Advocacy, and will be the moderator for today's webinar. Before I introduce our speaker, I have a few housekeeping notes. Today's webinar is scheduled for 60 minutes, including question and answers. Typically, we have a 45 minutes presentation, and the last 15 minutes will be exclusively for answering audience questions. We'll be leaving time for question and answers after the presentation. Please feel free to submit your questions throughout the presentation. You can do so by clicking on the Q&A link at the bottom of your viewer and typing your question in the box. The webinar presentation will be available to view after the presentation concludes in the chat box. We value your feedback, so please complete the evaluation survey before you sign off today. Globally, we are seeing a clear shift in favor of passive investing. And even in India, passive investing is seeing a great degree of interest in recent times. No wonder that CFA charter holders are keen to learn on the career prospects in passive investing. To speak on that, there is no one better than Anil Ghelani. It is my pleasure to introduce my friend and colleague with whom I share a board seat, Anil Ghelani. Anil is the head of passive investments and products at DSP Investment Managers. He's also the vice chairman in the CFA Society India board. Anil Ghelani, CFA, has been working for this DSP group since 2003. The DSP group has a legacy of more than 150 years, making it one of the oldest and most respected financial services firms in India. Anil is currently head of passive investments and products. Previously, he served as the business head and chief investment officer at DSP BlackRock Pension Fund Managers. Earlier in his career at DSP, he led the risk and quantitative analysis team, providing quantitative research inputs and buy-side credit research on companies across various sectors. Anil has worked prior to DSP at ILFS Mutual Fund and at SR Bartley Boy, a member firm of EY. He's been a volunteer with the CFA Society India for more than a decade and currently serves as the vice chairman on the board. It's indeed a pleasure and a privilege, Anil, to have you on board. Over to you. The screen is yours, Anil.
Sure. Thank you very much, Rajendra, for the very kind introduction. And I would like to take the moment to thank CFA Institute and CFA Society India to set up this wonderful platform for career insights. I think it's a very important way in which we can get to know and learn a lot. I myself have very often been on the other side, listening to many other fellow professionals talking about their career progression, their way of thinking about different elements of the market. So with that, I would like to wish a very warm welcome to all our participants. Thank you for joining this event. All of you, wish you a very good evening or good morning, depending on wherever you have joined from. From my side, I would like to take this session in two parts. I would like to go through some of the learning outcome statements that we had mentioned upfront, and I've kept a few slides as a placeholder as we go through these broad learning outcomes. And after that, we will keep it open for a very engaging, free-flowing question and answer led by Rajendra. So while I'm going through these few slides, articulating my views and perspective on the passive investments space, the hiring trends, etc., please do feel free to keep posting any questions or any comments that you might have, or you already have any questions in place in your mind. So with that, I'll just quickly move my slide. I hope my slide is visible to everybody. I'm just going to take 1 second and make my screen off. Yeah. So I would just like to discuss a very basic fundamental aspect of what we think about passive investing and what is active investing before that. So very often we talk about the classic form of investment, like when we talk about stock specific research, or we talk about building a portfolio, very often we look at the way in which investments is done. Like, we've studied as a growing up professional, we've read various books by the learning from legends like Ben Graham and security analysis. Broadly speaking, the classic form of active investing is what we think of as a kind of a combination of top-down and bottom-up. So we give some kind of a top-down view that, okay, this is how the broad economy is moving, this is how a particular theme is going to work, and within that, let's say these few sectors will be operating or having a visibility of this fashion. And then we add it up by a bottom-up stock-by-stock selection based on the judgment of the particular research analyst or the fund manager. So I just like to highlight this in a little bit lighter manner. Through the session, I'll try to keep giving some examples and some names of some books which can be useful for reading, or also some movies or series. This was a little bit interesting movie called the Kung Fu Panda, and if many of you might recognize this, there was the central character, the panda, and the father of the panda, and there was always this thing that he makes a very wonderful soup, and he never discloses his secret ingredient. So just wanted to keep that as a highlight, as a point, that in the active investing, the key element is the research input or judgment of the analyst. It's like how the subjective element is created, how the analyst or the fund manager views the particular stock or the sector. On that basis, they create their portfolio and take investment decisions. So I think we are all quite familiar with this, approach of the classic way of investing, doing research, stock by stock, bottom-up research. And suddenly then we come into the picture that, okay, well, there is a different element of investing as well, where we try to do a passive investing, where there is no human intervention or there is no judgment or human bias involved. So it's like in some form or fashion within the connecting back with the movie, it's like more about how to gain the market or how to meet the market or get the beta of the market while investing. So while the active investor tries to pick up the stocks based on his or her judgment that these are the stocks within this sector or this theme which are going to do well, and based on that, I will like to outperform the market or beat the market. On the other side, the passive investment tries to perform in line with the market, or say, I want to track or meet the market. So it's a very different approach in terms of saying that there is no secret sauce. How in the movie at some stage, the father clarified that there is no secret sauce. It's just you. It's your motivation, your work that is being done. So in some way, passive investing is that way, that there is it goes on the principle that there is no secret sauce, no judgment involved. You are just tracking a particular benchmark or a particular theme or a particular market. So structurally, within the particular passive investing, we'll go into the more detail, but in a very broad way, it ensures that there is a ongoing element of churn in the portfolio, but that happens by way of a predefined formula or a rule-based approach, not by a individual stock-by-stock judgment-based selection. So now, friends, if you look at the passive investments industry globally, when I say passive investments, I'm merging both ETFs as well as index funds, which are passively managed. And today, sir, if we see the professionally managed pool of money, like when we look at it as a global context, the entire industry is roughly about $100 trillion in size. Just it crossed 100 trillion for the first time in a few months ago. So this includes all professionally managed money put together across the world. From that, as of today, the ETFs or passive funds are close to about 8%. And now, if I connect that with Indian market, Indian market, we have got about 31 lakh crore, or in dollar terms, let's say about $425 billion of assets under management. From that, the ETFs and index funds are about 2,70,000 crore, or about $39 to $40 billion. So in some way, if you look at it, the Indian trend is right now pretty much similar to what we have seen in the global markets. It's pretty much similar. We try to have about we have about 8 to 9% of the total assets. But if we look at the growth, so what the various global consultants and research firms, who do the research on industry trends and all, so they have predicted that this 100 trillion will grow to about 150 trillion in the next couple of years, and that growth will be in a lot of way driven by passive funds, such that the passive funds will be about 25% of the total AUM by about 2025. So that means that in the next 4 to 5 years, the passive investments are set for a very large growth as per these consultant firms and research firms. And friends, if you look at actual data, last decade we saw in the US market specifically that 2013 was the first year where passive funds saw higher flows. And after that, in the next few years, the entire cycle has changed such that the last year, that is the calendar year of 2020, in fact, the passive funds only saw inflows and active funds, in fact, saw net outflow. So it's just a sign or just an indication of how the potential for a growth is there in this particular segment of the market. And somewhat similarly in India as well, if you see the last couple of years, like if I see 10 years back, this industry was virtually zero. I mean, hardly $1 to $2 billion worth of size was there. But even if we see the last 3 years, in 2017 December, the entire industry was roughly about 80,000 crore, 77,000 crore. And today it's close to about 270,000 crore. So there is a very sharp increase in the passive funds in India as well. No doubt the overall industry also has increased, but if we see even in percentage term, as we just discussed, it's close to now about 8 to 9%, 8 or 9% of the total assets under management. So it's just to highlight the significant growth that we have seen in the past couple of years. Now, what we feel, will this continue? What makes us think that the passive investments will remain in a growth phase in the next couple of years? I feel that in the global markets, one of the key arguments is about outperformance with the benchmark, where the discussion keeps going on that the passive funds are meeting the market and the active funds are not able to beat the market. So let us save the cost and go for low cost approach and invest into the passive index funds or ETFs. However, I feel strongly that in India, we still have a space for both. We still have a space for a lot of alpha generation that is outperforming the index by active funds. At the same time, in certain pockets or certain segments of the market, passive investments will also start coexisting and becoming an important piece of the market. So it's not that we'll continue to see the degrowth of active funds. Active funds will still continue to play a very important role, but maybe we will see a push coming up for the passive investments. And I would like to highlight just 4 key drivers, what we believe would be the reason or the rationale for this. First and foremost is the commodities. So as of now in India, we have only one commodity on which ETF is available, that is the gold ETFs. And that too is like pretty small in size now. So I believe that with the changes in the regulatory framework, where SEBI has now got the regulatory authority over commodities, I think in the coming years, we will definitely see much more of activity in commodity space, and there will be many more ETFs besides just gold ETFs, which will come up in the marketplace. The next is the fixed income or the bond ETFs. So till very recently, friends, the Indian mutual fund industry did not have any fixed income ETFs except for only liquid ETFs that was on the shortest end of the yield curve, and 10-year government security ETFs that was the longest end of the yield curve. So nothing in between, But now, since about one and a half years, we have seen the launch of the Bharat Bond ETF, and that has paved the way for many other such innovation. And I believe strongly that in the next couple of years, we will definitely see a set of new fixed income ETFs as well. The third driver is the government disinvestment mandates. So we have seen successfully since the past about 4 to 5 years, the erstwhile what used to be called as DOD, Department of Disinvestments, and now the DIPAM. They have used the ETF route very successfully, both on the equity side and now more recently, even on the bond side, for the purpose of their disinvestment targets and raising capital for the public sector undertakings or PSUs. So that I believe will continue. In many ways, that has helped in enhancing the awareness and visibility of ETFs also in the local marketplace in a very big way, because it did lead to a lot of retail participation in the past couple of years. And the fourth point is development and enhanced acceptance of smart beta or factor ETFs. So these four, I feel, will be the key drivers for the growth of the ETFs and passive funds in India. Now, friends, let's jump into this with the background which we discussed, that yes, okay, Anil, you are right. Maybe how the global trends have emerged in the US specifically, maybe we will see similar type of trends in India, and passive investments will be the propeller and drive the growth, and we'll see a multifold increase in the size. So what is in it for me? I mean, how should I operate in this environment, or how can I look at any career in this particular segment of the market? Because as we all know, sometimes it's great to grow with a growing segment of the market. So I would like to just highlight a couple of key points which will give a perspective of how I believe, in my personal view, the next couple of years hiring will happen in this space. So as we all know that in India today we have got about 40 odd asset management companies. Within that, these 40 odd companies, we have the entire assets under management split. And as of today, we have only about 15 AMCs who have got a meaningful presence in the passive investments and have products under ETFs and index funds. So what it means that maybe the rest of them will need at some point of time to do a catch up, or will want to be present in this space as well. So friends, we are talking about anything between 20 to 25 new companies who currently don't have this particular segment of the market will look to set up this particular platform. The second part is about the growth in terms of the existing players. So these 15 players have right now started with, let's say, a small base, small assets under management, maybe smaller teams. Sometimes they will have a common team, but the dealer is looking after both active funds as well as the passive funds. So as the market enhances and the assets grow, possibly they will also have a need for dedicated teams to be created, and enhanced hiring will be required as the growth happens. So other than the new players, which definitely will be there, we could also see expansion of teams for the existing players. And one very subtle aspect I would like to highlight here is that the global best practice for this is that the two teams are separate and dedicated. So for example, at our firm, at the company I work with, from the beginning itself, we created a dedicated portfolio management team. So me and my team, we sit in a separate dealing room. I have my separate access to market and separate Bloomberg terminal, separate recorded lines to execute my trades, distinct from the active team. So that as the size grows, this is the global best practice, because you need to have a clarity that there is no exchange of information, there is no overlap of the dealing bandwidth, or let's say that for a fact some large flow is going to come in a particular fund. So it is being taken care of in a very prudent way by that particular dedicated team. So as the size grows, even the existing players, many of them will want to adopt this kind of global best practices and maybe have a need for a dedicated team as well. And this would be resulting in hiring not just for portfolio manager or fund manager and dealer, but few other segments, which is, let's say, product development. There is a separate function called capital markets function. Many of the sales function will evolve. Even over there, in today's time, one needs to have professionals who have a very deep understanding of markets. Sales today is more about investment sales function. It's not like just relationship-based sales. So across these 5 functions, I think we could see a good size growing and a hiring being done. Now, I would like to touch upon the key roles and responsibilities of how a fund manager for passive funds operates. In some way, there is a subtle difference between how a passive fund manager operates. So I've highlighted here the key roles and responsibilities, to give you a clarity of thought that, okay, what exactly will it take, or what exactly will be my day like if I have to be in this particular area of portfolio management. So from the fund management perspective, I'm managing the flows. So what happens is that on a day-to-day basis, let's say for an active fund manager, typically speaking, you would land up having a cash of, let's say, 1%, 2%, 3% cash. Sometimes there is a frictional cash, some money has come in, the manager will think of some new ideas, allocate it in 1 or 2 days, liquidity based on the liquidity or the thoughts. But in the passive funds, you cannot have any cash lying idle as much as possible, because suppose you are having 2% cash and market goes up next day 10%, just hypothetically, you will go up but lower than the market, because that much is the cash drag. So flows management is a very crucial aspect of the particular focus area. And one very important thing, very often when I also talk to people, they say, you must be having a very relaxed time. As a passive fund manager, what do you need to do? It's like just there is no human intervention, so you have to just sit. I said it's not so easy. So I would like to highlight this aspect that yes, while it's clear that there is no human bias on a day-to-day basis from a research perspective, but there is a lot of fundamental research and analysis which goes behind initially selecting the particular indices or setting up the rules for the particular investment theme. And once that is done on a daily basis, you don't need to be tracking that, oh, this company has today announced the results. Now, based on that, let's put a judgment that the stock price will go up or remain flat or come down. So that aspect has to be made very clear in the mind of the professionals who are looking to enter into this field or enhance their roles into this particular area. Another very important aspect to highlight is the way in which the daily routine happens for a fund manager in the passive side. It's not like a very automated process. It's not an algo trading that, okay, some button is being pressed and automatically the flow is going and getting deployed in the market. There are a lot of moving parts. It starts with tracking the flows, of course, that how is the kind of flows coming today or going out. Other aspect of the entire process is corporate actions. So if there are any corporate actions which are taking place during the period, those have to be factored in, and they could become very complex at some point of time. So one needs to be aware of one needs a full grip on how corporate actions work in the local marketplace, how the entitlements will operate. Another very important thing which is there is about the dealing efficiency. So one needs to be very clear that which broker or which slicers will be used for the execution. So if the volumes are very high as a percentage of the traded volume on an average, so we are constantly monitoring that, okay, today suppose hypothetically there is a 100 million worth of or 100 crores worth of order to be deployed. We are constantly monitoring that the breakup of each of the stock which needs to be traded for that quantum of the execution. How is the historical volume and today's market, how the pulse is, in terms of whether we'll be able to execute accordingly. At some point of time, you need to time your execution. You need to ensure that you don't suddenly distort the market just because of your purchase. As such, you can't avoid it. Suppose if you have to buy or sell some particular basket, you can't take a subjective call and not execute it, but just some point of time, some subjective element of timing it during the period of the execution, that is a very important aspect of managing your flows. Another very important thing to highlight is that in our Indian context today, we have a concept of full replication. So in a simple example, let's say we have got the Nifty 50 as a 50 stock portfolio. So for a fund which is tracking the Nifty 50, they need to buy each and every of those 50 stocks in exactly the same weightage as the Nifty index. That is called full replication, as the word suggests, simple. But as we move to, let's say, larger indices, or let's say we move to mid and small cap, so at that point of time, assume we have got now Nifty 500. Okay. Now, in some points of time, you might not get liquidity in each of the 500 names. And structurally, you might not even need to buy each of those 500 stocks. So there, what we come up with the concept is optimization or risk-based optimization. So what it does is that it will run a arithmetic formula or a quantitative approach to determine that from this, let's say 500 stocks, if I were to buy or sell only these, let's say 100 stocks in a different weightage, the allocation will be resulting in a risk and return very similar to the underlying full 500 stock. So what happens is that in the global markets, this kind of optimization based approach is very often followed. But in India currently, from a regulatory environment perspective, all equity funds are using this full replication approach. So what we believe that as the market enhances, we will come up with this kind of replication and optimization. Both will coexist. So for optimization, the kind of fund management skills will be enhanced, because one needs to be very much quantitatively aware. One needs to have very robust optimization engines, which will be able to fine tune exact. Okay, these are the 50 stocks you buy, not the full 500, and this is the weightage in which you need to buy that. So that is another very important development slated to happen in our markets gradually. And another very important aspect is that though passive investments portfolio manager does not track individual companies or meet the management, but there is a requirement to have a broad connectivity and ensure that the company is doing things in a proper way. That comes because of the stewardship responsibility. So when I say stewardship responsibility, it's a very crucial role that we as a professional fund managers play, irrespective of whether the investment style is active or passive or semi-active or whatever. End of the day, we are managing investors' money in a fiduciary capacity. So there is a requirement to fulfill our stewardship duty, and hence we need to be tracking very closely the company's fundamental financials, various ESG factors. We vote on the proxies. So this also is a very different skill set that has come up and will be requiring much more enhanced engagement and involvement. So I would now move to the second part of this discussion, that, okay, I got a context of what the key roles are. Now, what are the competencies? So when somebody is hiring people, what type of competencies are looked at? Because that's the key thing for us to understand, that if one wants to build up a career in this, okay, I got the context, it's a growing industry, maybe it's a good idea to grow with a growing industry. And I feel the description of what a fund manager will do is quite interesting and very engaging. Now, let me see how I can fit in. So first of all, in terms of the industry knowledge, one needs to have a very good and robust understanding of how the overall capital markets function, how equity markets work, how bond markets work, how trading is done, investment. One should be in a position to have a good technical knowledge as well. And very important over here for passive side is to have a good grip on quantitative knowledge, good grip on how factors work. Factors are nothing but the key constituents of the risk and return of any particular security, right? And in a very common way, one of the leading such indicator is like the BARA, MSCI BARA. They have their various factors and they come up with the BARA models. So this kind of a good grip of the technical and industry knowledge is very important. Other than that, some of the soft skills that are required are very different from what an active fund manager does. So here, the fund manager needs to be somebody who has a very, very meticulous approach, somebody who comes with a very eye for the detail. Just by seeing the slide, one can say, sir, you have, I think, missed out some comma or some full stop over here that can result into the entire meaning of your sentence to change. Like that, in the portfolio, one should have a very precise eye for the detail that if I buy this stock, 5 shares or more, my percentage is going to get different from the underlying benchmark, and hence I will result into the portfolio will get a higher tracking error. So that eye for detail is very important. And in some way, I mean, I like to call it this way, that the active fund manager is in some form like a kind of an artist, right? I mean, you're painting a broad picture in your mind broadly that, okay, this is the way in which the broader markets are working. This is the way in which the sectors are functioning. And broadly, I feel subjectively, these are the few companies in that sector, and this is how I'm making a judgment of the future earnings and the growth of that company. And based on that, I'm buying or selling the stock. Here, it's more about a scientist type approach. This is what the numbers are telling. This is what the interplay of the different stocks and securities within the particular sector are operating. This is how my portfolio has to be constructed. And now once that is done, I'm methodically following that particular approach. So in some way, it's a very different soft skill, different aspect, which one typically has in place for a successful career in the passive investment side. And if we talk about the education background, typically speaking, very often I've come across people both in global markets and Indian markets who have a good background from engineering side, technology side, definitely from commerce side, of course. A lot of people were BCom graduates or commerce background also. But very often I have seen people who have engineering and technology background. Why I mentioned global examples also, because as we spoke in the earlier section, the passive investments in global markets is much more larger and has grown very fast. I mean, in India, we are just at the beginning of the growth. So teams and people involved are much more larger even in the global markets. Hence, I gave the reference of both sides. After the graduate, the bachelor's or undergraduate section, the second layer, like very often people are who are with a CA background, like, or have done a good MBA finance, and of course, a professional certification or enhanced knowledge enhancement or professional qualification like the CFA charter is of course very helpful or useful. So just to put that in context today, in my team, running the passive funds, I have got most of the colleagues who are from a similar type of background, and besides myself, like one of the other colleague, he's in a candidate currently L2. Another one lady, she's I think L1, recently just started. So very often we tend to see that the professional qualification like CFA charter also is very helpful or very useful, because it gives a good perspective of quantitative analysis, portfolio management, understanding how market cycles work, and overall getting a context of how risk and return interplay happens for different asset classes. What are the sources of hiring? Typically, when a junior level hiring is happening, not very common, but there are some fresh campus placements which also happen. Very often one can see movement from an index company. The index providers, they have many analysts who do quant-based factor analysis, etc., or who are involved in product development. So often they find a route coming into the asset management companies. Very often within the company also there have been internal moves. People from other departments or other functions such as fund administration or fund accounting, as we call it, or product development function, risk management function. Very often people in that function who are having a good appreciation of capital markets or of portfolios, and who are very often even pursuing some further studies for their professional qualification like the CFA charter, etc. They have had opportunities to move. I mean, I can recall in my team itself, one of my initial hiring was an internal move from a different department. For senior roles, very often it's lateral hiring. As of now, less so, because the entire industry is just shaping up. So there are very few people in Indian markets who are there for this particular kind of a hiring from competitor AMCs. But I think as we move forward, this will be a little bit more common. Very often we also have dealers or sales traders, from the broking firms, sell side areas. Or very often it could be internal elevation of within the function or within the team or within the company. So this is like the typical structure of a hiring. Now, very interesting, very often people ask me that, how do you see a career path, and do you see at some point overlap between the two? So I think very clearly that is sometimes very different and very distinct way of investing. So the career path of the passive investment team will be very different and distinct. So as we spoke in the beginning, that there is no human bias involved. The approach is very different. You are looking at quantitative data and models and running your portfolio. From a fundamental perspective, you need to have a good macro or a top-down view, but you don't need particular stock-by-stock views. You need to have broad sector views, sometimes to even guide your clients, or sometimes to decide which fund should be working better. But there is no stock-by-stock selection or actively meeting company management, etc., which the active investment portfolio managers would be doing. So in some way, the two operate in a very distinct expertise zone. So I'm not saying that it's never overlap, but structurally, it's very difficult to create an overlap between the two. So if you are an active portfolio manager, very less chance that you will be in a position to successfully transition into passive side. Likewise, if you're a passive fund manager, you will continue with the approach in this particular area, maybe enhance your book of business, run portfolios which are larger in size, or be in a company which has a larger business, or more sectoral funds, more thematic funds, newer quantitative models which you will come up with and successfully deploy them. Likewise, from active side, let's say if you are a particular sector specialist, maybe you will enhance your role into different more sectors, or enhance your portfolio management. But the transition between one and another is not going to be very common or very easy. I mean, to be very clear about that. And friends, it's not just about portfolio management or fund management. I believe that the growth of the ETFs and passive investments will lead to people like us who are finance professionals to be having enhanced career opportunities in some other functions also, such as, for example, product development. So I think that is also a very important piece of the entire ecosystem, where people will be required to keep thinking of new design, new ideas. One would need to make sure that that new design or new idea needs some proper incubation. Very often there will be a requirement to do a paper trading or a back testing of the entire idea before it can be commercially launched. So it's a kind of a, in some form or fashion, a pseudo fund manager role, which is sitting very close to the fund manager, but technically a distinct team working on analyzing various parts of the market, working on incubating and designing new products, constantly talking about the key aspects of the products or about the benefits of active investing, passive investing, creating thought leadership pieces, research approach. So that is a very important function where many of the CFA charter holders or even candidates can be finding it useful. Another aspect is capital markets, because there is a need to be well connected with the various elements of the capital markets, buyers, sellers on the exchange. And other than that, not just the asset management company where the funds are being run, but there are also some other elements of the entire ecosystem. There is a very important element of the ecosystem that is a market maker. So when an ETF is trading in the exchange, like any other security, there is a two-way quotes being available, right? So there is a market maker who constantly puts in two-way quotes, and their job is to just earn between the spreads, like a normal market making for, let's say, FX or commodities or whatever you think of it. Something similar is done for the ETF as well. So that ecosystem also will evolve. Like 15 years back, there were just 2 or 3 handful of people who are doing market making. Now, there are much more enhanced number of players who have started doing the market making, because as they are seeing increase in the ETF size, natural progression is that higher trading volumes will happen. So their business also will grow. So the market makers will be setting up bigger teams. Likewise, index providers, they will need to set up bigger teams. They will need to have more and more new products. Plus, new index providers will come. So today there are many global index providers. For example, MSCI, FTSE, they are not present in a big way in terms of their funds being present in India. Whereas in the global markets, they are the very large players. So over the period of time, we could see new index providers also coming. So they will need a hiring process and teams being created. Plus existing teams will need to be expanded and enhanced. Stock exchanges will be required to further enhance the focus on ETFs. They're already doing a lot, but they will, as the size keeps increasing, they will keep doing more. So a lot of hiring and expansion will happen over there. I've kept investors as a category. What I mean by that is that there could be very large investors, family offices, corporate treasuries, and they will need specialized attention to this segment of the market. So I've just kept that also as a placeholder. The other two parts are brokers. Of course, they will need to be servicing the trading, the volumes, the flows. So their role will be also very crucial and very important. And securities lending. This is a very important part, especially in the passive funds, that the entire portfolio is available on a daily basis. So very often the portfolio securities are lent out and there is lending fees on that particular lending. And mind you, securities lending also is a very, very important piece of our overall capital market ecosystem. So what happens is that suppose there is a negative view on some particular stock, so there will be some traders, arbitragers who want to take a position against that. And to implement that, they need to borrow the stock from the market. So that's why people like holders of those stocks will come in and lend those securities. So it acts as a good functioning of the overall capital market as well. So globally, it's a very large piece, a very large part of any capital market ecosystem across various markets. Even in India, in the recent few years, it started growing very rapidly. And as ETFs and index funds grow, I think they will be a very natural lenders in this particular securities lending market. So that also will be a very important piece. Everybody around it will be involved. So wherever there is any RA or a reverse arbitrage opportunities, securities lending will become active. Wherever there is any forward, like normal forward transactions happening, that time the F&O market typically becomes more active. So I think that securities lending is a very crucial piece of the entire ETF ecosystem, and gradually that will also need a lot of specialized professionals, who will be focused only on that aspect, across, whether it's in the mutual funds or in the broking side, or there are specialized services, let's say from custodians who offer this particular service. So with that, friends, I would like to throw up for any questions. I think we had a good discussion from my side, but I would like to make it more open and have a more engaging dialogue. My friend Rajendra is there, and I'm sure you all must have got some questions which you must have kept noting down. So I would like to spend the next 15 to 20 minutes to take any questions or any comments or any suggestions. If you have not thought of anything, please do feel free even right now to post your questions, and we'll try as much as possible to take them. If not right now, subsequently through a blog post, we will try and ensure maximum responses are given. So with that, I would like to bring back Rajendra, and Raj, look forward to catching up with the chat with you.
Yeah, thank you, Anil, for that very lucid presentation. You made it very simple, and I'm sure that the audience would have enjoyed the way you presented it, and also made sure that you covered every last point in terms of the queries that the audience might have. But even then, I think this is an exciting and rapidly developing field. And obviously, there are heaps of questions that the audience has raised, and I'm quite excited to share with you some of the questions which you may want to answer. But before that, as a reminder, again, as Anil mentioned, please, if you have not submitted, please go through the Q&A link and do so at this point in time without losing much time. So we have some time to answer these audience questions. So Anil, here we go. There are quite a bit of questions, so hopefully let me see how much we can trigger. But first of
Sure,
all, I
sure.
mean, let me combine a few questions and ask you. I think the key thing that you raised in your mind is in terms of the rapid growth that is going to take place in the passive, not only globally but also from India point of view. If we have to move from say a 8% to a 25% region in the next few years, and internationally, of course, we have seen that incremental flows are going largely to passive, and we have seen massive outflows from the active field. So when you are looking at that, I mean, there is a trend towards passive happening, and in that sense, I think there are a couple of things from an Indian perspective. I mean, what do you see? Do you see some kind of a structural, regulatory, technological, or even knowledge kind of bottlenecks happening that could thwart this kind of a growth? So India might miss out on this growth phase.
I think, Raj, there is no question that we'll miss out on the growth phase in the coming years.
Yeah.
I feel that, in fact, we have caught on in a very good way. See, there are no reasons why there should be a lagging in the growth. I don't see any such areas. In fact, over the last few years, we have seen an enhanced visibility of the passive funds, ETFs, the entire ecosystem, which in many ways has been very much smoothened out. Like I remember distinctly, like let's say about 10 years back, very simple thing like there used to be double layer of STT. And many of those small inefficiencies or so-called spin breakers have very clearly been now taken care of, and everything is smoothened out. So just imagine now today we have reached earlier, as I said, 10 years back, maybe we were hardly 10,000 crores of total size. Now there is a size of about almost close to 2,75,000 crores, which includes some very large mandates by the government. So I think some of those small hiccups have been cleared. Yes, certain areas still need a lot of change, but I think from our side as a industry body, as a MFI, I mean, they are very much actively discussing that. From regulators side, from SEBI, they are very open to discussions, adopting global best practices, and constantly reviewing. So I think we'll be in a very good position, Raj, for the growth.
Okay, thanks, Anil, on this. But if you are, I mean, I think there's another interesting offshoot of this question is if the massive
Sure.
inflows are going to come through the ETFs, and incremental flows are going to be more in this field. I mean, even both in terms of growth as well as the quantum. So how do you see that? I mean, do you see that purely investing into index stocks rather than out of index stocks would be a better way to get returns, or you would have a different proposition to this?
In Indian markets, as I mentioned, I feel that the scope for generating better performance over the index is definitely going to continue for the next couple of years. However, within that, I feel that for a large cap space, more specifically, where there is a much more higher level of research being done, there is a much more greater level of transparency of the way in which the earnings are being released on a very quick basis, and the way in which the active managers have to showcase their performance measured against the TRI, total return index. These are the 2 or 3 reasons in the last few years whereby the outperformance in the large cap space has become much more challenging than what it was, let's say, in the previous decade. So we have done a lot of analysis around it that in the previous decade of 2000 to 2010, the average large cap funds were able to comfortably beat the, let's say, Nifty 50 as an index by about 3-4%. But in this last decade, then that has narrowed a lot. So I feel that the scope will be there, but I think in mid and small cap space, that will be a better scope to do out of index and try to outperform the market. But in the large cap, maybe passives will grow in a bigger way. So it's a both. I mean, coexistence of active also growing as well as passive funds suddenly seeing a shoot up.
So you feel that there is a scope for both active and passive to coexist, and it is not that it's an either or situation, right?
Absolutely, yeah.
So let me just pivot quickly onto the career prospects in passive, because that's another area that's,
Sure.
and of course, that's the key
Yes.
first of this presentation.
Yeah. Yeah.
So many of them feel that, as a recent graduate, I mean, if somebody is a graduate and still not completed CFA or any of the professional exams like CA that you mentioned, is
Mhm.
there still a scope in terms of getting directly into passive investing, or what are the other things to do in order to convince a employer to recruit such persons?
That's a very good question, Raj. And I would say that whether it's in passive investments or in active or any other such role, I believe that at some point of time it becomes a little bit challenging because unless the candidate or the professional is in a position to demonstrate some kind of a qualities or characteristics that yes, I have a good grip and understanding of the capital markets, of uh, the way in which asset classes are driven, or what are the key drivers for risk and return of the particular asset classes. I feel that for anybody to take the call, whether it's a passive fund team or active fund team, it's going to be a little bit challenging. I'm being very honest and candid. I'm not saying that it's not possible, but it becomes a little difficult. Then in such situation, the ideal path would be internal transition. So I'll give example, like, if somebody is working as a, let's say, fund accounting team, let's say person is not finished post graduation, like, or a CFA not done yet, or like, is just like a in the process and working in a, let's say, operations role, accounting role. Then within the firm, you can try to enhance your visibility, create a extra knowledge, and then try to position yourself for such a shift. And along with that, then you can supplement that side by side. Okay, I'm being given the opportunity, and side by side, I will enhance my knowledge further by completing, let's say, some other professional course like the CFA program or XYZ, whatever might be the situation. I think that would be a good path, I mean, to do.
Okay. So basically, you are saying, if you are an internal candidate, it makes it even more easier to get into passive investing than from an external straight through method, right?
Yeah, if you don't have any exposure and experience in capital markets, neither in broking side nor in, let's say, quantitative research with some index provider, or any kind of a uh, prior related experience, then how will you come in the limelight or in the vision of the hiring manager? So maybe then this could be a different route or a better approach.
So we always, have this concept of a star fund manager in an active management, right? I mean, there are always people who
Sure.
swear by certain gods of investment, so-called. But in passive, typically, because of the way it is structured, you may not really have a star fund manager department. So to that extent, you feel that, there are other areas of which are more valuable to a passive industry fund management industry, like product development than investment management itself?
Sure, very good question. As I mentioned in the slide towards the end, that apart from portfolio management, product development is definitely very important. Capital markets is also very important function. See, in India, we don't have that function yet evolved or developed. But if we look at the global best practices, or any of the global players, like I'm saying from personal experience, like earlier, like you might be aware that I was working with the joint venture presence of the largest ETF manager in the world. I mean, so seeing the teams, how they were structured in the global markets, this capital markets function, Raj, is a very crucial part, because they act as the bridge between the various investors and the market makers. They know, or they are tracking the liquidity, where it's coming from, who has got the holding capacity, or how the particular trends are moving, or which sector ETF to currently position to their clients. So in that sense, that also becomes a very crucial piece of the entire uh, passive business, because the fund manager is sitting at his or her dealing room or desk. Okay, capital markets person is actually out there ensuring the proper visibility of their products and accessing the particular market players and getting the money for the fund manager to manage, plus managing the client's liquidity requirements. So I believe capital markets function as well as, yes, you're right, product development function is also very crucial. And absolutely right, there is no concept of star manager. So how should I say, that star effect gradually will be taken away from this particular piece of the industry.
So basically, I think the scope is much broader than just narrowly limited to the investment management process.
Yeah, absolutely right. Yeah.
So I mean, there's another interesting thing is in terms of the scope itself of ETFs, right? It straddles beyond just stocks, and it goes into commodities and various kinds of commodities, etc. So do you see the mechanics of operations of an ETF different for different asset classes in that sense? And then you briefly touched upon the concept of market maker. So how does a market maker play a role in terms of making ETFs accessible?
Sure. I'll first try to cover this commodity side, Rajendra, because that's very crucial. And I mean, I'm personally very much hopeful that in the next couple of years, that will be one of the big driver. See, today, because of various regulatory angles, the commodity is controlled by some other entity, some other regulator. Mutual funds were earlier by some other regulator, and there is a very much important aspect of the prices of commodities in the overall our economy. So till recently, it was not very easy to, let's say, even buy exchange traded commodity derivatives. Today there is MCX and NCDEX, the two commodity exchange players, where quite a lot of activity is happening. But as a professional asset management company, we were not in a position to participate of that. Now all that is changing gradually. So other than gold, let's say there could be silver, there could be crude oil, for simplicity, I'm just saying. And at certain stage, there could also be other areas like, let's say a basket of agri-related products, or let's say basket of base metals and precious metals combination. So these are the areas which I believe can be, point number one, very crucial for the market's development, for those markets to have participation from institutional players. Plus, it can be a good addition to an investor's portfolio. That is a crucial part, and hence the growth will come. See, because today as an investor, you need to have a diversified portfolio across even commodities, equities, bonds. Right now, when you talk of commodities, typically it's just, okay, equity, bonds, and gold, and that's all. But gradually, people will realize that other than gold also there could be, or there should be various other commodities which can be held in the portfolio. So I feel that will be a very important driver for the growth in commodity ETFs in the future.
Yeah. So you mentioned about market maker. Do you want to cover?
Yeah. So yes. Yeah. So the role of the market maker is also very important in the entire ecosystem. Hence, which I showed that chart of the entire ecosystem. What happens is for ETF, when it is trading on the stock exchange, the liquidity is very crucial. Suppose today you want to sell an ETF worth 5 lakh rupees, and if you don't see liquidity in the market, there is no healthy bid offer spreads, then you will not be able to sell, or when you exit, you will suffer a haircut or a wide spread. So for the passive side, always one sees what we call as TCO, total cost of ownership, not TER, total expense ratio. So the TCO includes the bid offer spread, the cost of the brokerage that is being levied, the STT, etc., everything. And the market maker is the entity who holds some inventory of the ETF and then constantly gives two-way quotes of buying and selling. So any investor who wants to enter or exit can comfortably be doing so. So in the entire cycle, of course, if you are buying index funds, then you don't really bother about market liquidity. You just go to the asset management company and place your investment or redemption. But whenever you're doing ETFs, you need to have a healthy liquidity in the market, and the market maker ensures that remains in the on the counters. And at the same time, they are making their money, right, by giving the bid offer spreads. And hence I mentioned, Rajendra, that even a lot of growth in that space and a lot of money to be made. So teams will be created by these kind of market makers. Globally, there are a few specialized companies who do only market making. So there are these firms called like, Jane Street or Trade Flow. I mean, they are globally very large renowned market makers. So they typically make marketing anything and everything wherever quotes are being done. Two-way quotes, they put it in any stock, bond, commodity, ETF, everything. They will also soon come to India, hopefully, as their business is seen or growing, or they see a potential. So many of these global specialists who are only market makers, they will also come into the capital, in the Indian markets, and we will see a lot of hiring, a lot of career development opportunities in that side also.
See, sometimes we use quant for passive, etc. In terms of interchangeably, but I'm sure that there is some kind of a difference there. So, do you see? In the beginning, of course, you covered that a lot of engineers also get employed in the ETF industry. Do you see there, any scope for people getting into quant? Is it the career prospects different from purely ETFs that we are covering here?
For certain smart beta ETFs that will be developed, or for example, certain multi-factor products, like we as a house also, we have today a very successful fund called DSP Quant Fund, where we have merged 3 factors and created a portfolio. So at the design stage of this kind of products, the quantitative analyst or the quant-based inputs are very much crucial and very required. After that, on a day-to-day portfolio management side, tracking the fund's performance, investing in the daily flows, or the secondary market making, the securities lending, in all of those elements of the flow, the quant analyst typically does not get involved. So yes, it's as such an integral part of the entire passive investing ecosystem, but structurally a little bit different from the actual portfolio management or dealing. But yes, very often people who come with a quant background or quant analyst type of a background land up being very successful in portfolio management of passive funds as well, which is why I had mentioned even in one of the competency criteria that people with quant backgrounds or quantitative analytics are very much preferred.
So I think we are running out of time, but there are lots and lots of questions. I think you triggered a huge upsurge of interest, Anil, and thanks for that. But
Sure.
Having said that, just 3 questions I'll pick out of this lot.
Sure. Okay.
The first question is, what's the role that deep learning or artificial intelligence plays in passive? Because we keep hearing this particularly related to passive investing.
See, Rajendra, I think deep learning and machine learning, artificial intelligence, etc., I think will play an important role in future for designing new products or thinking of the, as I mentioned, in a passive investment context, initial research and fundamental analytics is very crucial. After that, there is no daily research. So at that stage, let's say a large voluminous analytics which is done. So in that, let's say the AI ML related things will be very useful. But I don't still feel that in a day-to-day portfolio management activity, we can beyond the point automate or use artificial intelligence for that. But yes, for the analytics, for the quantitative research, for the back testing, definitely this will be very much a useful trait or characteristic.
A lot of our participants are asking about any few books that you would recommend for understanding more on passive investing. Is it something that is available?
See, I think from reading material perspective, lots is available. One very basic thing, if you want to read, I would recommend strongly go to our CFA Institute resources itself, and there is a very good ETF guide or ETF compendium which has been released. That gives a very beautiful coverage of all elements of how the industry operates, key segments of the market, global trends of the growth, and also the of course it won't speak about the skill sets and the competencies and all what we discussed today, but it will give a very good background about how the industry works, what are the key areas. So I urge all of you to just look up for that guide. I had in fact request, I think a lot of copies for my team, whoever new colleagues join, or many sales new colleagues, I always give it to them. I have it also in one of their copy, a little bit old one now. So it's called A Comprehensive Guide to Exchange Traded Funds by the CFA Institute. maybe I will post the link to this. It's freely available for download from our CFA Institute Research Foundation. The CFA Research Foundation, and even non-members of the CFA Institute or people who are professionals who are not candidates also can very easily download it. I think it's the classic book. Without going into too much of technical for one section, it gives a very good overall perspective for the professional to understand.
So one last question is that many people have, wanted to be guided in terms of the career prospects in passive and how to pivot from, active to passive or other from other fields. So is there somewhere they can get in touch through your, are you active on LinkedIn, Twitter? Is it something that you would encourage people to do that? Because I think there have been quite a few questions on how to be mentored or coached or guided through.
Sure. No, I would be quite flattered if one would like to be in touch. I mean, thank you for that. Yes, I do use my social media. On LinkedIn, I request, instead of connection request, just do a follow request. It's very challenging. I mean, and I don't use LinkedIn like Twitter, that I just accept only known people's friend request. But otherwise, if you want to track my updates or anything, please feel free. I've just put up my slide. I mean, I'm very open and accessible through my social media. But besides that, I would like to highlight one key element and conclude with that. Friends, I mean, this kind of platforms are the most powerful things, where you can hear the capital market experts on both sides. Like as I mentioned, I also often log in and listen to these kind of series. You get to understand, generally what's happening in which element or which part of the market. So I urge you to be more and more active in our CFA Society platforms or CFA Institute, various initiatives or networking platforms, knowledge sessions like these. And that will ensure you get a good mentoring or good analysis. I assure you, I guarantee you, if any of the people who are listening to this session today, or anybody who is listening to it as a post recorded session, if you would have reached out to me individually one-on-one, no doubt, maybe I would have taken time to speak with you, but I assure you, I would not have been able to take it in this granular, detailed manner, or we would not have the fortune of having Rajendra sir also along with us for this engaging type of discussion, which brings out more questions and more pointers. So sometimes these are the more useful tools which you can use for career guidance and mentoring. But otherwise, yes, surely, I mean, I'll try my best wherever possible to respond to any request on social media platforms as well. And one more last thing, Rajendra sir, I'll take another 60 seconds, because very often this question, a few of them I have read right now also, or very often they get posted to me as well. As a career progression or a trend, friends, I'll just be upfront. Even I have not suddenly parachuted into, oh, I finished my CFA charter and now give me a job and I'm now CIO or I'm a fund manager and handling the portfolios, right? I mean, sometimes it happens gradually. So I'm also CA first by education. I gave the career path. That was my path. When I joined the industry, I was earlier doing auditing business. From that, I joined mutual fund, doing fund accounting related activities, operations role. Okay, from there I moved into a risk management function. Then we got involved in credit research. Then at some stage there was an opportunity. I moved into a pension fund management role, and then this passive investment started. So I was, fortunate to get the opportunity to do that. So very often, don't have a baggage that, oh, I am from this background, or how will I look at it, or nobody's hiring. Start your operational journey gradually. At some points of time, you can showcase yourself in a better way. You have so many tools, LinkedIn, social media, people will notice. Then when a right opportunity comes, I'm sure you will be in a position to make a different progression into your career as well.
Yeah, thanks, Anil. That's very insightful presentation today. So before we end, as a reminder to our listeners, please do complete the evaluation survey that appears on your screen at the end of the session. CFA Society India, CFA Institute members may claim professional learning credit by logging in their online professional learning tracking tool. Upcoming webinars, if you have not registered already, please do so now. It's on 18 February 2021 between 5:30 p.m. to 6:30 p.m. IST. That's on Practitioners Insights, Futures and Options in Indian Markets. The speaker is Saurav Sisodia, CFA. So thank you once again for participating in today's webinar. And Anil, once again, thanks for your insights.
Thank you very much.